Welcome to the third episode of the Think Property podcast. And in this episode, I'm going to be talking to James Randall of IPM SIPP, and we're going to be discussing all things SIPP and in particular property in SIPP. So, James, welcome to the podcast. Thank you very much indeed for taking the time to join me.
No problem, Edward. Thanks so much for having us. Looking forward to it.
And I understand, obviously, one of the considerations to think about with regard to a SIPP is that it is FCA regulated. Is that right?
Right. I'm kind of old enough to still remember the times when SIPPs weren't FCA regulated, but we have been now, and it's been a fairly positive, or completely positive, should I say, outcome for the SIPP industry. But that does kind of mean I have to tread the compliance line a bit carefully these days. So I just need to say,
go for it.
If this is okay, we'll get this out of the way early. It's just to say that although my employer, IPM SIPP Administration Limited, we are FCA regulated by the to provide a SIPP, a personal pension, we are not regulated to provide financial advice. So this chat today, everything we're going through here, this is just purely information, and if anyone is thinking about acting on anything that we're discussing here, we would always suggest go and see an IFA, go and see a financial advisor to make sure that what you're going to do is the best outcome for your circumstances, because this may not be suitable for everybody.
Yeah, absolutely. Echo that as well. In the same vein, I'm not regulated by any entity, and this is information only. So if you like what you hear today, please do go and seek out independent financial advice. So yeah, perfectly put. Thank you. So James, you touched on the fact that you're employed by IPM. You personally, what's your background, and can you tell us a bit about IPM after that?
Yeah, sure, no problem. So my background is man and boy in pensions, and also man and boy with IPM. So I have been with IPM now for over 22 years, and we are celebrating our 25th anniversary this year. And we're just a bespoke SIPP provider. So that is all that we do. So we don't have any investment platforms to promote, and we absolutely do not provide any kind of financial advice. My day-to-day role is about product development, but also supporting financial advisors, who's our primary target market, if you like. That's who we'll go to say, hey guys, if you need a bespoke SIPP provider, we'd like you to pick IPM over the other guys, basically. And there are many great SIPP providers out there, and I'm sure we'll go through the chat, Edward. SIPP providers have different approaches, different risk profiles, and therefore there is not a kind of SIPP that has one size fit all. Some will do commercial property, some won't look at it at all. So from the commercial property angle, it's a very large part of what we do. We own over 1,100 properties within the scheme, and we typically have anything like 30 to 40 transactions going on at any one time. And over a third of our team at IPM are in our property department, because again, as I'm sure we'll go through, buying a property is not like investing in stocks and shares. You know, it can be emotive, it's emotional, especially if the client who is the SIPP beneficiary, if their business is occupying the property. So there are lots of different considerations there. So SIPPs for 25 years is what IPM have been doing, and commercial property for that same period of time is something we're very experienced in.
That's brilliant. Thank you. Really helpful indeed. A couple of things you said there. So bespoke was one of them. Sorry, I'm just checking. Have you got an echo on the end of the line there, or is that just me?
Oh, no, you're coming through nice and clear to me.
Okay, wonderful. All right, great. Yeah, so you mentioned bespoke. You are a bespoke SIPP provider.
Yes.
I appreciate you're also extremely professional. I've known you for a number of years now.
Thank you.
And I expect that you're not about to sort of denigrate the opposition at all, and there's nothing good that comes from doing that either.
No.
But what do you mean by bespoke, and what makes you different to other SIPP providers?
Yeah, so when I go and speak to new financial advice firms, I will typically kind of say to them, look, we'd love to get every SIPP client that you work with at IPM. That would be ideal. But we know that's not going to be the case, because regardless of fund value these days, there are many low-cost online SIPP platform operators out there that will do the majority of the work that the most clients will need. So regardless of fund value, if clients want to invest in stocks, shares, funds, discretionary fund management, all that kind of stuff, there are many great low-cost SIP options out there. When you get into the bespoke world, it's something where you can't really just pick it off the shelf. It needs a bit more care, and typically it needs more service. And I'd say we're one of around 10 to 12 SIP providers in the market that are really dedicated to this kind of work. You can't really buy a commercial property online. You need a bespoke SIP provider. You need someone who you'd be able to pick up the phone to and chat with. And it's not always necessarily the financial advisors we work with that every property case that we do goes ahead. We've spent months and months working with our advisors trying to get a situation whereby it's all going to work out for their client. But actually, like you all know from your experience of property, Edward, something happens along the line. The chain breaks down. A valuation comes back with a concern or something along those lines. So, you need that level of personal support. As I say, there's quite a few SIP operators in the market that offer this. And as I say, from IPM's perspective, it's something we've been doing for 25 plus years now. So we're experienced in doing so.
Okay, cool. And what I'm going to do is just pull us back, if I can, a bit, because I think immediately with our familiarity of this sort of SIP world, I think we've maybe sort of made a few leaps too far. So first of all, can we unpick a few things? SIP, what does SIP stand for?
It's a self-invested personal pension. So I'm sure anyone listening who's got an interest in this kind of stuff will be very familiar with the last two, personal pension. The self-invested angle gives obviously that opportunity to do a lot more investing than just typically from an insurance company.
And last week I was talking to a SaaS administrator or a SaaS provider. You mentioned just earlier on in this call about ownership, that you own a certain number of properties. Is that a key distinction between SIP and SaaS, that actually the SIP administration firm has a handle or a hand in the ownership of property if there is property in the SIP?
Yeah, absolutely. And I really enjoyed your session with Nathan. I listened to that at the weekend and really enjoyed it. And I was listening to it thinking, I'm sure there's going to be an opportunity for some sort of distinction between SIP and SaaS. So it might be just good to kind of just go down that route a little bit now.
Yeah, please.
Ultimately, SIP and SaaS are kind of the same thing as far as HMRC are concerned. The flexibility of what you can do there, the tax benefits, which again, I'm sure we'll get into, they're broadly similar. But the difference between SIP and SaaS, as Nathan very well put when he was talking about SaaS, is that you have the clients as the managing trustees, and then typically you have someone like his firm who will be the practitioner or they will be the professional trustee. So they're basically there to make sure that you don't do something you shouldn't do. But ultimately, the responsibility for running the scheme on a day-to-day basis is to the managing trustee, which would be the clients. So the difference with a SIP, and especially our SIP, which is a master trust SIP, so we are the sole trustees, IPM are the sole trustees to the SIP, is that when I say we own the properties, I mean we as in IPM as the trustee company. So our role here predominantly is to make sure that the scheme runs in accordance with FCA regulation and HMRC guidelines. And so if a client comes to us and says, we would like to buy this property, please, we would make sure that we're comfortable in terms of our risk tolerance. Now, certain SIP providers have different levels of risk tolerance. Certain SIP providers won't even allow commercial property at all. So even though HMRC say, yeah, you can buy that within a pension scheme, they're saying no, they don't want to. Whereas ourselves will say, yes, we can buy it. But if there was something which crossed one of our red lines, then we would say no. And the difference between SIP and SSAS in that respect is the SSAS has the member trustee. So the member trustee might say, well, that doesn't breach my red line. I'm quite happy to proceed with it. Whereas us as a SIP provider, as with the final say, as the owner of the asset, we might say no. But the reality is we always try and find a solution and always try and work hard. And the times we really say no are very few and far between.
So then in layman's terms, would it be fair, and please do correct me if I'm wrong, would it be fair to say then that actually commercial property held in a SIP, because of your involvement and those red lines you've referred to, and the FCA, I suppose, and that sort of oversight, is it fair to say that someone that is the beneficiary of a SIP has may prefer a SIP because actually you provide that level of experience and security. You're bringing to bear 20, what was it, 25 years of
Hmm.
company experience,
Hmm.
and just making sure that those choices are the right ones. Is that the right way to couch it?
Yeah, I mean, you're obviously talking to a guy that's got both feet planted in the SIP side of the fence and has done so for 22 years, but I will try and be as balanced as I can. I think what is probably more pertinent, Edward, is that if you're a managing trustee of a SaaS, you're obviously going to be entrepreneurial because they're occupational schemes. And as Nathan explained, it's linked to a company. So typically, these kind of people have a lot going on. Do you then want to run a pension scheme on top of that with the day-to-day responsibilities? Now, some people love that responsibility and they're very happy to do it, and that's great. But the conversations I more have are more actually, we want to buy this property, we want to take advantage of all the tax efficiencies of owning property within a pension scheme, but actually, I don't want to be doing the day-to-day VAT returns, or I don't want to necessarily be doing the rent review or anything along those lines. So we will look more towards the SIP operator to do that because we are the legal owner of the asset. We're going to run the scheme on a day-to-day basis, and we're going to take care of the majority of the running of the scheme. And it's not just property as well. There's annual returns to HMRC. If you take in an income from the SIP, you've got to pay the tax over on POA and stuff like that. The SIP trustee will do all that for you, where more of that responsibility under a SaaS would fall on the member trustee, i.e. the client. So while SIP and SaaS both have the same flexibilities, and there is a greater degree of investment flexibility as far as SaaSs are concerned. Actually, I think a lot of people prefer the SIP route because they don't have to get their hands dirty day to day, but they still have that same element of control because the SIP provider is not going to do anything unless the client instructs so.
Okay, that's a really helpful distinction. Thank you, and thanks as well for sort of treading as carefully as you did along those sort of SIP v SaaS partisan lines. So, okay, so you talk about day-to-day control.
Yeah.
If we assume, for argument's sake, that I am one of your clients and I
Mm-hmm.
have a light industrial building in
Mm-hmm.
a SIP,
Mm-hmm.
and I'd like to extend that building or develop it in some way,
Mm-hmm.
presumably with your involvement, your ownership of the property, the SIP owns the property,
Yeah.
so you have a veto potentially on that development activity. You'd need to see that certain criteria were being met.
Yeah, absolutely. I mean, and when I was prepping for this today, I was chuckling to myself. So I thought we can get into a massive can of worms quite quickly, and here we go, because there are lots of different angles we could go down here. But I'll try and be succinct so we move on quickly. Um, Ultimately, we are not going to just stand in the way because we feel like it. There has to be a reason as to why we would say no to something. So it needs to be remembered as a trustee, if with your light industrial unit, like you suggest, if you want to extend that, no problem, that's fine. But that's an investment of pension scheme monies. So as trustee, we need to see that's going to be a good idea. Now, if your unit's worth, say, £100,000 and you want to spend £50,000 on an extension, some new roof, something along those lines, that has to be paid for by the SIP. So what we need to be able to demonstrate and be comfortable in is that's going to return a decent return on the investment. So what we wouldn't be comfortable with is if you spent £50,000 on those works, and then actually the value of the building has only gone up by 10,000. So why is that a good investment for the pension fund? We're open to talking and dialogue and you putting a case forward, but on the face of it, doesn't make sense. So we'd need to understand that and work with you to get that. But kind of another slight deviation, and again, we'll probably come onto this in more detail, is if you wanted to knock down that industrial unit and build some flats or a residential building or something along those lines, we're going to say no to that because that means HMRC tax charges apply. So that's where we could veto it. But these examples are very few and far between. The first suggestion of your light industrial unit is something we see day in and day out. So we're very used to dealing with it. But as I say, we're here to look after the pension fund first of all, first and foremost, that's our priority. Protect it from HMRC, protect it from the FCA. And then if we can accommodate and make sure we can do what it is you want within the scheme, we're open to that. And we'd very much look to try and achieve that.
So that example, again, I'm guilty of just jumping too far ahead. That example was around me being a hypothetical client with
Yeah.
a property in the SIP. let's come back a bit again.
Okay.
Presumably the perfect client is someone that comes and knocks on your door and says, I'd like to set up a SIPP. I have a business that operates from this premises, and I'd like the property itself to be in the SIPP as well. Is that it? So how do you basically onboard a property into a SIPP or into
Okay.
one of your SIPPs?
Yeah, fine, no worries. I will kind of then just jump back a bit on you as well and just say normally we wouldn't have clients approach us directly. We normally work with financial advisors. Yes, people do approach us from
Yeah, you
time to
said that.
time.
I beg your pardon. Yeah, you
Yeah,
were clear on that in the beginning, actually. Yeah,
yeah.
sorry.
That's okay. And we do have mechanisms and mechanics in place to ensure if anyone does come to us directly, we can assess them. But because of our regulatory position and because also we want to ensure good client outcomes, going through the financial advisor is always the best way of doing it. So let's just assume that a property scenario is put to us. Okay, so we would always just try and work with the advisor and the client because normally it is a dual thing. It's not just the client's cut out. We sometimes sit in on meetings with the clients as well as the financial advisor. And as you say, they want to buy their building that they operate out of. I think there's this perception of buying property within pension schemes that it's really scary. That it's this crazy thing that no one really understands. And quite typically, the people that want to do this are entrepreneurial types anyway, and they're quite sophisticated from an investment perspective. Buying a property in a pension scheme isn't really that different to actually buying a property outside of a pension fund. You just have the pension tax wrapper sitting around it, and then you have the trustee, like us, having to make the final decision. So we would initially take a look at the property, and we're not talking about really in-depth stuff at this point. There's only so much you can do until you have the SIPP structure set up and you instruct solicitors. And a SIPP can buy any commercial property. And for us, we will buy any commercial property based in the UK on a freehold or a long-term leasehold basis. So as long as it fits that really broad description, we'll take a look at it. And so we'll want to know what the value is. We'll want to know what goes on in there. Who's the tenant? What's the rental income? Is it VAT registered? Will there be borrowing involved? How are you going to fund it? And just work through that dialogue in advance. This is all in advance of the SIPP being established. So as of yet, no solicitors have been instructed or anything along those lines. And as long as there's not something that's glaringly obvious at that point, which is going to cause us an issue as a trustee, either from our red lines, HMRC, FCA, we'll say, let's move forward. And then the SIPP structure is set up. Some money's put into the SIPP. We instruct solicitors, and then it's just the usual conveyancing process from that point onwards.
What you're saying is really, really succinct. Actually, it's very helpful and it's very clear. And I think what I want to try and just tease out is those details
Yeah.
that are really going to be valuable, because the ideal listener to this is
Yeah.
someone that is thinking about doing exactly what we're talking about.
Okay.
They maybe have had the idea in their head for a period of time.
So can I make a suggestion?
Yeah, go for it.
Property and SIPPs really dovetail nicely is when you talk about tax efficiencies.
Yeah.
So you do that capital gains tax, you talk about income tax, and then you talk about companies operating their businesses from premises owned by the pension scheme, so corporation tax deductible, all that kind of stuff for the rent and things along those lines.
Yeah, absolutely. Okay, so let's actually dive into that then, because
Yeah.
the question I had, which I was trying to form, was it was along the lines of you're dealing with someone's IFA and you're dealing with the customer. The customer will sit in on the meetings.
Yeah.
Let's say the customer owns a business. Is highly likely to own a business and potentially likely to operate that business from the building that they want to put into the SIPP. So, yeah, there are going to be tax efficiencies there, and I'd love to come on to that in a minute, if I may.
Sure.
But what about beneficiaries of the pension? Is there a cap to how many people can be named as a beneficiary of the SIPP, or is it just one family, or is it one person? How does that work?
Yeah, so again, that was another good point. I was listening on your podcast with Nathan, and he spoke about the number of people that can be a member of a SSAS, and then that's obviously limited to a specific number. With a SIPP, it should be remembered it's a self-invested personal pension, so the personal bit's important. So In the majority of instances, a lot of the SIPs that we establish that have a property will be just one person who buys a property, and that property is held within the SIP, and then everything else goes around it. But it is certainly not unusual, and we've been doing this as long as I've been at IPM, for a SIP to buy a property in conjunction with another SIP. So typical would be business directors, spouses, people with a common interest. And so husband and wives, or say co-directors, that would be normal. The biggest SIP that we have is over 30 members of a barristers' chambers, each owning a percentage of a property within a group SIP arrangement. So there is no limit on numbers. And I think the important point to make is that each of these individuals have their own SIP. So if you imagine there's husband and wife, they have their own SIPs that are here. And then if they wanted to buy a property jointly, we would create a group SIP arrangement, which sits above the two individual SIPs. And then you would move money from those individual SIPs up to the group SIP arrangement, so on a 50-50 basis. The property is then held in the group SIP, so money goes in from individual SIPs into group SIP arrangement, acquires said property, property sits in group arrangement, rental income comes into group arrangement, and then gets filtered out to the individual SIPs. The benefit for what I see with that, and this is just my own personal opinion, is that by operating in this way, you're able to combine pension monies. So I give you greater buying power, give you ability to buy bigger properties or bigger premises or more desirable premises, whatever it is that you want, but you still got the individual SIPs underneath it. So if one member of the group wanted to take benefits, for example, there might be some work that needs to be done in the group SIP, but they can do that kind of independently of one another. If they've got different attitudes to risks of the rental income that's coming in and how they want to invest it on platforms or in cash deposits or anything along those lines, they can do so independently of one another. So whilst you can combine the pension monies and have that group SIP, which ultimately gets the goal that they want, by having those individual SIPs underneath as well, that does still give you the ability to kind of have that individual pension arrangement, and not everyone else needs to know your business.
Okay, that's brilliant. And those individual SIPs, can they be with other providers, or do they need to be ported across to you as well?
Yeah, it's funny because it's a question we've been asked, and we haven't never done that. And I know other of our peers in our space have also felt the same way. They've never done it either. So I would say that if it's IPM or any other SIP provider, all those SIPs would need to be with the same provider. And I think that's just from a practical perspective. For example, we don't have a requirement to pick a specific property manager. And in some instances, we were happy for the client to be the property manager on IPM's behalf because we are the owner of the property as the trustee. Other SIP providers, they insist on a certain firm being a property manager. So if you're SIP provider A and SIP provider B, and you've got kind of conflicting ways of how you're actually going to operate on a day-to-day basis, that's just going to get too messy. So if you are in a group SIP arrangement, I would say have all your SIPs with one provider.
I'm grinning because actually I do remember umbrage back in, I think it was sort of 2011-12 time, when a certain SIP provider, who shall remain unnamed, was insisting on a certain very, very large property manager to be used.
Yeah.
And actually, it just made no sense at all because the properties were typically of a certain size and value, and also disparate locations up and down the UK. That really made the use of that particular property manager very expensive indeed. So it's really quite refreshing to, and I'm going to emphasize that point then, that you do not insist on a specific firm of property managers to be used. But again, you have your red lines and you just want to make sure that there's probably competency there on the part of that property manager, whether that is the SIP beneficiary or not. But that's actually could be very, very attractive to anyone potentially working with you or coming on board with you.
Yeah.
Okay, cool. So in which case, that's quite a nice segue then onto this next bit, because you've talked about this pooling of SIP monies and that very clear structure that you set out with the sort of the SIP on top with the property in it, and then filtering down into separate SIPs underneath. What are the tax and financial arrangements around that? Perhaps you could maybe just elaborate the benefits.
Yeah, sure. And again, this isn't going to be suitable for everybody. This is a very broad brush kind of overview on tax efficiencies of property. I think probably the first place to start, Edward, is to remember that all these exciting things we're talking about in regards to property and SIPs and how you can use your pension schemes in different ways, it should always be remembered that the ultimate reason that pensions are there is to provide clients with retirement funds, retirement benefits. So in order to provide for their future. But if you think about it for me, what you want from a pension scheme investment is good long-term asset growth, and you want good investment return. And so I think obviously a property could achieve both those goals. You've a property for 20 years, the likelihood is going to go up. And, you get someone in on a 5-year lease, it's not unusual for us to see 8, 9, 10% yields on that. So actually, as an actual investment for a pension scheme, obviously things can go wrong along the way, but as a headline, just looking at it, it's very attractive. But the tax efficiencies which you mentioned, I think that's where it does dovetail quite nicely, because if you hold that property within a pension scheme for 20 years, when you come to sell it, there's no capital gains tax to pay. So you imagine what advantage that could have during that period. Any any rent that's received by the SIPP is not subject to income tax. So again, that's a win as well. And where you get the double win is if the client's business occupies the premises which is owned by the SIPP, then they must pay rent at market value to the SIPP for use of that building. Now that rent could be a business expense, so corporation tax deductible, comes into the SIPP income tax free as well. And I'm a little bit conscious, like Nathan was, that we've got a budget in a few weeks' time, which is giving us all a few headaches. And there could be some changes along the way. So I was going to go on to say about the ability to pass on property in a pension scheme outside of an estate for IHT. And then you can move that down through the generations. We very much have seen family businesses hold properties within pension schemes where maybe mum and dad set up the company, they have it at the moment, and then you have the children will have their own SIPs. They might be the beneficiaries of that asset. And that can all be tax-free if it's death before age 75, and there's a manageable tax to pay out for death post 75. So I think that as an actual investment for a pension scheme, property does tick a lot of boxes. But then when you put the tax efficiencies of pension schemes in with property, I think that's where you do start to hit the sweet spot.
Yeah, that's brilliant. Thank you. And what about borrowing? Because quite often people buy real estate with some form of debt facility to sit alongside their equity. Is that
Yeah.
possible with a SIP?
Yeah, absolutely. So again, this is where the HMRC guidelines come in. And notice I've said guidelines a few times, not rules, because guidelines are open to interpretation. And this is why you might ask one SIP provider a question and you'll get a answer. And then you'll ask another SIP provider a question and you'll get a different answer. And so borrowing is possible within SIPs. You can borrow up to 50% of the net scheme assets. And that's just a really complicated way of saying you can borrow half. So if you've got a £300,000 pension pot, you can borrow up to 150,000 to swell your pot, then go off and buy a bigger property. And obviously that that 50% net scheme asset value is it's quite considerably less than typical loan to values you'd see, 80, 90%. So actually banks tend to be a lot more comfortable with lending to SIPs once they get their head around lending to a SIP, which sometimes still causes issues. But once they've kind of got their heads around that, then actually, there's not as much risk for them as well. But we have varying degrees of success with borrowing about the amount being borrowed. So again, anything below 100,000 there's not always great appetite in the market for it, as it would be in any transaction, not just for SIP operators as well. So borrowing is absolutely possible. With IPM, you can work with any bank. Obviously, the big ones out there, your Barclays, your Lloyds, your NatWest, those kind of guys. We've got lots of loans with those guys. Brokers as well, we can work alongside. So talking about when we jump back earlier about the element of control, we don't have panels. So the clients can negotiate their own terms in the borrowing. And they come to us and say, hey, IPM, we want to borrow with Barclays over 10 years at this rate, at this arrangement fee. And we go ahead and facilitate that for them.
You mentioned this in one of your answers. You were looking at the prudence of that investment. Is it likely to increase in value? What's the rent profile likely to look like? Do you rely on chartered surveyors to tell you that, or do you do your own calculations in-house on projected property performance?
So a part of our initial assessment is we'll always ask the advisor and client combined, what are the fundamentals of the investment? So purchase price and rental income is what we're looking at. So that initial conversation, we will take the word of the financial advisor and the client we're working with, because we're all working together, and that's fine. As we progress, we absolutely will need a RICS valuation to be provided. And that will need to have the value of the property, and it'll also need to have the market value rental as well. Now, where it's a connected transaction, and by connected I mean that it's someone who is connected to the SIPP beneficiary, so them personally, a business of which they're a director, if they're selling a property they own or their business owns to the SIPP, it must be at the commercial value as in that RICS report. That's a RICS surveyor's report. If we're putting that business as the tenant into the property owned by the SIPP, it must be at the market value rent as determined by a RICS surveyor's report. The reason being is that HMRC don't want to see people taking advantage of the SIPP to their own financial benefit, and that's either by underpaying for a property, so you're getting a larger value asset into the pension scheme, or vice versa, overpaying, so you're getting more money in and out of the business than the SIPP, or alternatively, you're over or underpaying rent. So underpaying rent, obviously that's a good thing for a business because you're getting a lovely building and you're not spending as much on the rent. But equally, if you're paying over, you're getting more money into the tax efficient structure that is the pension scheme. So as I say, initially, we'll work together and discuss the fundamentals that if we are able to move forward, we would need that backed up by a surveyor's report.
Okay, and then how, if I'm speaking with an IFA and we get into conversations with you and everything goes to plan, on average, how long does it actually take to become one of your clients, have the SIPP set up and have the property all bedded in under your administration?
Edward, you've been working in property for a number of years, and I'm sure you know that is a question that is loaded.
All right. Okay. All right. Let's put some. Okay, go on then.
And I'm going to say it's in two parts, because one part is the actual recommendation and establishment of the SIPP and getting the money into the SIPP. And that is down to the client and the financial advisor and how they work. Because we, as a SIPP provider, cannot do any formal work until the SIPP's established and it's got a small amount of money in it. And for us, we're talking not even 4 figures of money in there. It's just enough to instruct the solicitors. IPM, we can set up a SIPP same day, as long as we have all the information we require, and money is to be placed into the SIPP the next working day. So realistically, we could get to a point within a week of having a SIPP up and running, money in it, and solicitors instructed and moving on with the purchase. The bit that's the loaded part, which I'm sure we can discuss, is how long will the transaction take thereafter? Because there are so many moving parts. There are so many different things that could trip things up along the way that it's just like any other property purchase. There are some that we've completed in a matter of weeks that have gone great. There are some that have taken over 12 months. And that's not because it's being bought through a SIPP, which is, I think, is the perception that's sometimes done, that buying through a pension scheme is really complicated. It doesn't have to be that way. Yes, there is an extra layer of complexity, but for us, that's normally done at the outset when you're setting up the SIPP and funding it and finding the SIPP provider and all that kind of stuff. But once you're starting the process, it's like no other property transaction. And I think just to kind of take that a step further, I mentioned earlier about the bespoke SIPP market and those 10, 12 firms that are in there that do really good jobs. It's just important that whoever that is, whether it be IPM or any of the others, that the advisor and the client find the firm that fits and works for them, because it will be the SIPP provider who does buy it. And it's just important that if you need anything to be done, that you are able to contact those people at the SIPP provider and get things done and have that communication and just check things out and get things signed off, because it can cause delays if you're waiting for a SIPP provider to come back to you or something along those lines. But as I say, in the bespoke SIPP world, you don't tend to have those those service issues that you might see with much larger organizations that take X amount of working days to get things turned around.
Okay, and then I think rather than talking openly about your company's fees and things like that, which I think would be unfair, and I'm sort of, this is obviously episode 2 or 3 of this podcast, and I'm sort of learning as I go along. And I think actually in my mind's eye, whilst it would be incredibly helpful for listeners to hear what your fees are, and obviously I'm speaking with other companies about their services which are outside the pension world as well. Actually, this isn't a time-bound podcast. This could be listened to in 2 or 3 years hence, so it makes no sense to actually talk about your fees. So I think probably the best way around this question is asking for you to confirm if I'm correct, and that is that buying a property in a SIPP with a SIPP wrapper, you are exposed to the normal sorts of fees that you would expect. So a chartered surveyor's valuation fee, anything to do with any financing. So you may have an inbound fee, arrangement fee for bank debt, that sort of thing. You may also, you are definitely going to, in fact, incur solicitors' fees for the transaction. And then through the years where you, the SIPP administrator, are administering that property in that SIPP, there will be your fees as well. Is that pretty much covering it off?
Absolutely, yeah, and you've hit the nail on the head. Those are the main ones to consider. There's some little deviations there, which if you allow me just to talk about, I'd be happy to.
Please do. Yeah, please.
So solicitors is one. So again, I'm very conscious I don't necessarily want to just talk about IPM. I want to be quite general. But IPM, we would always prefer to work with panel solicitors, because the reason is that our solicitors are buying on behalf of the pension scheme, and buying properties for pension schemes is different to buying it through any other structure. So we have a panel that we prefer to work with, and they work to a schedule of fees which we can produce in advance to show that this is where the likely fees are to incur. If a transaction is protracted, solicitors charge a bit more, and that's the same within SIPPs. But other SIPP providers may allow you to use your own solicitor, so they don't work to a panel. So you may find that we talked earlier about finding the SIPP provider that works for you. It may be that IPM's not the one for you if you don't want to use our panel solicitor. So it's things along those lines which are really important to people. But also in terms of the SIPP providers' fees, they can vary significantly. And not just in terms of the annual fee you're referring to, because most bespoke SIPPs, such as ourselves, will charge an annual administration fee of multiples of hundreds of pounds for the work that we do. That is to be trustee of the pension scheme and to do the work on a day-to-day basis. But the variations of fee structures for SIPP provider is really vast in terms of buying the property. Fees are normally charged for that. Some providers will charge an annual property fee. Some providers will charge an annual borrowing fee. There'll be fees if you want to move money. There might be fees if you transfer in, make contributions, all these kind of stuff. So it's just really important that whoever you work with, you fully understand the charging structure, because it can sway quite significantly depending on which provider you pick. And that's not to say expensive is always bad and cheap is always better or anything along those lines. That's not necessarily the case. It just goes back to what you want from a SIPP provider. And I guess, value is based on the service you receive. You deem what the value is, right? So some people are happy to pay higher fees to get a perceived higher value of service.
Yeah. There are a couple of things in there that I want to just tease out a bit more. And I think I'll use the fact that I am completely impartial to sort of give my own view. And again, just for clarity's sake, this is not advice, it is information. But normally I would see clients kick up a bit of a fuss about the idea of having to use a panel. But I do think, in fact, I believe very firmly that when it comes to SIPP and SSAS, taking the recommendation or a panel provider on solicitors is absolutely key. And the reason for that is that there are some nuances to buying a property in a pension wrapper, which are not overly convoluted, but they seem to get the better of solicitors that don't do this thing on a regular basis. So I think for a smooth transaction, and I know that there are a couple of names at the tip of my tongue, which I won't cite, but I'm absolutely certain they are your panel solicitors as well. There are certain solicitors out there in the market that do seem to have a very, very good grasp on this. And I think actually for a future podcast episode, it maybe would be good to get one or two of them on, actually, just to talk about things from their point of view. The other thing that you touched on there was, I was grinning a bit. You were talking about other providers and their fees. And actually, out of interest, I've gone to the websites of some of the bigger operators in the SIPP world only, and looked through the brochures. And I've been quite surprised at some of the fees that are sort of hidden in there. So £70 an hour for speaking to an administrator, for example. And again, from my experience, it's that sort of thing that has really caused umbrage. It's caught people out. And again, I'm talking from my experience working back as I did for Curtis Banks, as you know. And I was face to face with a lot of their clients when I was sort of dealing with their property interests. And fees create a lot of noise, a lot of negative noise. If someone goes to your website, would they be able to download your fee structure and sort of understand it very clearly? Or is it actually, you said bespoke, do you set out your fees on a bespoke basis for clients?
We like to keep things simple at our place. We don't want to try and reinvent the wheel, and we certainly don't like things to be more complicated than it needs to be. And that also just extends through to how we charge. And again, very conscious, I don't want to talk about our charging structure, but for us, it's not so much relevant these days, but if a client has a SIPP with us and holds one commercial property and it's got rent coming in, and then we invest it on an investment platform on behalf of a client, why should we charge more than a client that might have 10 different deposit accounts where we're having to do 3-month rolling notices and stuff like that, where it's actually probably day-to-day is more work. So actually the answer to your question is yes, our fee structure is easily available online. And also we do have a kind of cost comparison article in our news section, which talks about commercial property within SIPPs and buying commercial property and just the things to look at and how SIPP providers' charges can vary. But as I say, for us, we charge a flat annual fee, and we don't try and charge additional annual fees on top of that, unless something like a property's VAT registered. So we've got to do quarterly VAT returns, for example. So we charge an extra £200 a year to do that. But typically, like you were saying with the perception of fees, if someone's just buying a property, holding it in the SIPP, then once the property's acquired, we pretty much pride ourselves on the client should know exactly how much we're going to charge year in and year out thereafter. Because, as I said earlier, people don't mind paying for fees, in our experience, as long as they're receiving value. It's when you're not receiving value for those fees and you're not getting the service you expect, that's when the problems start to rise.
Yeah, we've covered off the beginning of the journey. What about the end? I know there are references to things called crystallization events, which is where typically evaluation is needed and some sort of report or some such is required for the regulators. Could you talk about sort of notable points at the end of a sort of SIPP lifetime?
Yeah, for sure. And I think, even with the fact you're bringing this question up is important, because you can talk about all the exciting things you can do about buying property within your pension scheme, renting it back to your company, the tax benefits of corporation tax deductible rent coming in, all that kind of stuff. But let's go back to what we were saying earlier about pension scheme investments. Yeah, this is here to be an investment for your retirement pot. So actually, you need to think about the exit strategy as well. And so when it comes to actually wanting to take things like your tax-free lump sum, and again, I'm kind of stuttering a little bit over my words because we've got a budget coming up and we're not sure what that's going to look like in a few weeks' time. But, if you're going to take a 25% tax-free lump sum, there needs to be sufficient liquidity within the pension scheme to do that, right? If you've got your entire property invested in a SIPP, entire SIPP invested in a property, that's pretty tricky to do. And so when you come to the exit part of it, it's important to think about how long you're going to hold the property for, and is the rental income going to build up to build that liquidity to pay your tax-free lump sum? Because actually, you're not going to want to get to a point where you need to take your benefits, but yet you don't have the liquidity, so you need to sell the property. So there's things like that to me to be considered. But coming back to the group property arrangement, we have something called 4Ds at IPM, and I'm going to test myself now if I can remember these. So drawdown, death, departure, and divorce. And by that we mean from the group. So the 4Ds are all reasons to generate liquidity for the pension fund. And so drawdown is in that. There needs to be sufficient drawdown amongst the group in order to generate that liquidity to pay out those benefits. So again, it's all very well and good coming into it thinking this is a great idea, but actually when people come together to join the property and one of them says, I want to take my tax-free lump sum and I want to sell the property to generate that, well, how's that going to affect the rest of the group, So absolutely, I think that the most important thing is, yes, is this the right thing for us to do? But what's this going to look like in 10, 15, 20 years' time? And actually, does this align with what we want from our pension to provide us with retirement benefits, not just the journey along the way of actually doing the investment in the first place?
Awesome. That's really, really clear. Thank you. From your perspective, is there anything that we've missed in this conversation? Is there anything where in your sort of 22 years of experience, you've sat down with IFAs and they've either asked you a question on a very common basis or their customer, your client has asked you a sort of very common question, and possibly simpler the better as well, actually.
Yeah, we don't want to get
very,
too
very
much.
afraid to ask the basic questions, though.
I think we cover most of the main ones off. I mean, as I said to you at the beginning of this, I think there's loads of cans of worms we can open. The only thing which is coming up quite a lot for us at the moment, which we haven't touched upon at all, is that we're also able to buy land within the pension scheme as well. And land opens up a whole new opportunity for dynamics of people, groups of people. Farmers, but the first one you think of, either they have a lot of land they want to sell to their pension fund or they want to increase their portfolio by buying land. And although I don't have the figures to hand, I feel like we're getting a lot more land inquiries at the moment to actually buy land within the pension scheme. And I think whilst we can consider it, where we struggle with land sometimes is that you've got to come back to HMRC and their guidelines. Any investment made by the SIPP has to be on a genuine commercial basis. So if you buy a shop, it's very easy to demonstrate that commercial basis, right? Because you have a tenant in there and they're selling cards or they're selling cakes or whatever it is they might be selling. That's easy to do. But with land, it's not always so straightforward. You might have a farm business tenancy lease in place, and again, that takes care of it. But we've been asked to buy land before because it's nice woodland, or because it's over the road from someone's property and they don't want anyone to build on it. Those aren't the kind of things that are a genuine investment for a pension scheme. And even if there are genuine investment reasons, we'll take a step back to what our role as a trustee is. If we're buying a property, we're making an investment, or buying land, we're making an investment of pension scheme monies. And so we need to see decent rates of return. And with land, we're getting approached with things that are less than 1% return, when at the moment in our trustee bank account, you can get 2.6%. So we need to be convinced as to why this is a good investment for the pension scheme as well, because ultimately we're trying to do the best for the pension fund, and that doesn't always necessarily sit well with what clients maybe want us to do.
Yeah, thank you. Then to conclude, what is the size of your business? What sort of comfort can you give to a listener that is maybe thinking of picking up the phone to their IFA and saying, look, I want to get in touch with IPM about setting up a SIPP? I think it makes sense. We have seen, in fact, I've already mentioned Curtis Banks. Curtis Banks now merged with Nucleus, or have become Nucleus. A massive, massive company in this space. Massive does not necessarily mean good. and I'm going to be particularly careful about making sure that neither of us denigrate anyone out there. That is just not a professional or positive thing to do. But what sort of plans have you and your team got around the scale of IPM, and how would that impact a potential customer?
Yeah, look, and just to echo your comments with Curtis Banks, I do speak with financial advisors that are very happy working with Curtis Banks and the larger SIPP providers. And that's why, again, I say that it's important whatever provider you pick suits your particular requirements, because, working with a smaller provider such as IPM, which I'll explain in a moment, compared to Curtis Banks, might not be something that someone's very happy with. So it's down to each individual to work that out. But in terms of us, we have just over 5,000 clients. We have assets of around 3 billion. We've been established for 25 years, and it's all that we do. And because we only offer a bespoke SIPP, so we don't have a single investment SIPP, we don't have an online SIPP or anything like that, is we offer online logins and stuff like that. But what I mean is you can't just go online like with AJ Bell, for example, and set up a SIPP within 5 minutes. We're a more traditional bespoke SIPP provider like that. So as far as we're concerned, people come to us because we can offer that level of flexibility. And it's the same with the other 10 to 12 I keep on mentioning in the market. They offer a similar kind of approach. But as I say, from our perspective, we don't look to grow by hundreds and hundreds a year, because that's not our business model. As far as our business model is concerned, if you do a good job and a client stays with you, we charge an annual fee. And as long as that annual fee keeps on getting paying, that makes us a profitable firm, which is what we are. And ultimately, we have long-term succession plans in place. So we're a privately owned company, and the shareholders, they're not going anywhere anytime soon. Most of them work in the office on a day-to-day basis as well. But there needs to be that succession planning, because there has been some horror stories in the SIPP industry over the last 10 years or so. Yeah. And, from our perspective, we just want to carry on doing what we're doing. We don't want to be the biggest SIPP provider in the world. We just want to be the best of what we can do. And so we're always very happy to help with any financial advisor kind of inquiry, or just to assist on any property related matter. But as I say, in the interest of fairness, there are lots of good SIPP providers out there. And most importantly, out of this conversation, if anyone's listening to it, if it just makes them think about properties and SIPPs and thinks about the advantages, thinks about their own circumstance and how this could help them, first of all, pick up a phone to a financial advisor and have a chat with them to see whether that's the best thing they should be doing. And if IPM or any others can help thereafter, then I'm sure we'd all be very happy to do so.
Also, you had a schedule of fees and you had a comparison article on your website.
Yeah.
I'll get those URLs from you after this call, if I may.
Absolutely.
And I will just put those in the show notes.
Yeah.
And also your website contact details. But James, thank you very much indeed. It's been absolutely fantastic speaking to you, genuinely. Mm-hmm. Off the back of last week's podcast, I've already had a number of questions about, you didn't ask this, or could you have asked that, and whatever. Hopefully the same thing will happen again, and maybe, I think actually, in order to be fair as well, we get you on after the budget. So if you're happy to, sometime in the new year, we have a bit of a follow-up chat, just to see what impact the budget had on the world of SIPP.
Yeah.
And also address any of those questions that I have missed out today, if that's all right.
Yeah, look, we'd be very happy to do so. And although I can see we've been talking for a while now already, I feel like we've barely touched the surface. This is such an in-depth conversation to have, and it's just one that I don't think people are having as much. If people aren't aware of it as much. So kudos to you for bringing this up as a conversation piece, both myself and Nathan. And by all means, any support we can give to you and your podcast, we'll be very happy to do so.
You're saying we barely sort of scratched the surface. I know that, and you clearly you've mentioned it. And I think what we need to do is just continue to talk. So if you are happy to sort of come back on this podcast, maybe we can actually exchange some notes beforehand so that we can structure something that we think will be really helpful for listeners, that sort of gets them over a number of unknowns or problems that they think that they're going to have, and just dissolve all those barriers, I think would be pretty good. Also, you've been really, really clear all the way through about this isn't advice, this is information only, your Financial Conduct Authority regulation for IPM, that sort of thing. I think it's probably pertinent just to make absolutely clear, as per my podcast call last week with Nathan at Seabridge SSAS, that there is no financial or referral type relationship between myself and your firm. So I'm quite keen that that remains the case, because actually I want to be having conversations with you and others that I know, like, and trust, rather than the bias of some sort of financial kicker if people come to you off the back of this podcast. So yeah, just to make it clear, there's no financial connection between myself and you guys. But that was awesome. Thank you. Really, really helpful. And let's see what the budget does in a few weeks' time.
Yeah, hopefully not too much, but I'm not very hopeful of that, I'm afraid. So if you can't contact me after the 30th of October, just give me a few weeks. And
Okay. All right. That's brilliant. Thank you. And
cheers, Edward.
we'll wrap it up there. Thanks a lot. Bye
Thanks
bye.
very much.